I'm Osborne Foreman, and in this week's portfolio update, I'm going to show you the UK stocks I bought and sold, as well as the top diver and riser in the portfolio. And if you like the video, please drop one of these to beat that YouTube algorithm. According to Google Finance, the FTSE 100 is up 2.42%. The FTSE 250 is up 1.71%, and as of recording, the S&P 500 was up around 0.5%. I'll put the updated number at the top of the screen. My portfolio, yet again, has massively underperformed the markets, dropping by 5.07%. In fact, the last month has been very high volatility with my holdings in the portfolio, despite the general markets rising. This has very much tested my conviction as well. Whilst I have the stomach for volatility, and this is usually a good trait, in this situation, if I'm not too careful, this could actually be a bad thing. For instance, if my stocks aren't well researched and the quality of them are actually low, this could mean that I'm buying a dip and actually catching a falling knife, which if I try catching a falling knife, I'm going to get hurt even more. I'm confident in my ability to pick stocks, and so that is why I have the conviction to buy more or buy the dip rather than cut my losses and invest elsewhere. After all, I'm invested for the long term, and so the short-term price changes aren't that big of a deal for me because I will see this stock in 5-10 years time and it will likely be much higher. And I am dollar cost averaging, so things are much easier to take advantages of the dips or the peaks. Just before we continue into the rest of the portfolio, please note that I have a Patreon. So if you're interested in my Patreon page, click the link in the description down below. This week, Boohoo released their full year results for 2021, which ended at the end of February. They had announced that they had grown their revenue by a staggering 41% year over year or year on year. This is really impressive, combined with a gross profit that increased by 42%. Furthermore, they had 18 million active customers, which has increased 28% year on year, and also a net cash position of £276 million. Shares in this stock have actually fallen this week by 4.97%. This tells me that investors had expected this, and it is really no surprise as the last year throughout the pandemic, they have benefited massively. Whereas I don't think this is a good valuation for the company, and I feel that they justify a much higher premium. If shares continue to fall because ESG funds, which are ethical, social and governance, fund managers do not want to invest in Boohoo, then I'll very likely buy the dip. Boohoo is my largest position. I do hold 2,500 shares, and my investment overall is up 27.85% since holding mid-July 2020. Lower now because they have made some substantial investment. However, this net cash position of £276 million can be much lower, and this is because they have made some substantial investments. This could be the fall of Arcadia, the acquisition of Debenhams. I can't quite remember the exact date, and so this could have fallen after the report of the full year results. Furthermore, they did buy a top-of-the-line office in Soho, and I think did make some changes to their example factory in Leicester. And so this cash position could be considerably much less, and the executives are on the move or in progress to receive their bonuses, which could be more than £150 million. I don't mind if ESG funds want to avoid this stock despite them making all the correct movements to improve the governance of the business, then in my opinion it's their loss. Maybe they know something more than I do, and to be honest that's very likely, as what do I know as a private investor? Besides the point, I think I'm going to take advantage of this. They ignore it, I will buy it, I'm fine by that, and over the longer term, once they eventually recognize it, providing Boohoo continues to make strides in improving their ESG, then I think they'll just reinvest back in and they'll miss out on a majority of the gains. Boohoo's outlook for 2022 is only 25% revenue growth. Considering they've had a staggering 41% revenue growth this year, I think they are under-promising and potentially going to over-deliver in the next year. What I mean by this is that they're not going to say that they are going to get 30-40% revenue growth despite their CAGR in the last 5 years being much higher than 25%, I think it will be a good one to watch. And as investors start to realize that this company is probably going to do better than that, they may start buying back in. Team 17 was actually the top diver this week, with shares dropping by 10.83%. Fortunately, this is my second smallest position in the portfolio, and so the overall portfolio wasn't drastically impacted by this swing. Regardless, it seems like the outlook for the industry of games development has certainly lowered a lot. This is because they had a fantastic year in 2020 due to the pandemic, more people being at home, and therefore spending money on entertainment such as video games. It makes a lot of sense as to why that was an abnormal year, although I do believe with the quality of Team 17's management that they will continue to do well. Not talking 40% growth like Boohoo, but I do think they will get some strong growth. Shareholders likely believe that Team 17 are unable to sustain their previous growth in the last year, leading to the correction that we are experiencing currently of over 10%. I've not bought any shares of Team 17 just yet, but they're certainly back on my radar. And for one, it has taught me patience. Whilst I dollar cost average into the market every single week, I don't necessarily need to buy these stocks. And in fact, I can wait until they have a correction or they see a market movement that may be more favorable to buy. Rather, if you take this time to watch the movements in your shares, you could then perhaps take more advantage, although you may fall victim to trying to time the market too much. So there are positives and negatives to this approach. It is very easy to find winning companies that will dominate over the longer term. It's much harder to buy those companies and hold them through the dips or the tough times. If you're interested in signing up to Freetrade, which if you haven't noticed is my stockbroker on the side of the screen, then you can get a free share worth up to £200 when you sign up using my link in the description down below. Halma is a holding I've spoken about frequently on the channel. This week I've trimmed 25% of my already very small position. This is equivalent to about £130, which in the grand scheme of the portfolio really isn't much, and I've continually trimmed this, taking minor profits on the way. This is because I no longer believe that Halma fits well in my portfolio. I believe they will continue to outperform the general market. I would like a higher risk to reward ratio. I would like to outperform the market, well, firstly get to the market's performance, as I am underperforming as of right now, get to it, and then maintain a higher CAGR. I'm hoping that in the next few years that CAGR will even out, as 2020 was a fantastic year for the markets, but not necessarily my portfolio, but overall it was a good return for the first year. Regardless, despite this point, I feel that Halma is at a size where their growth is limited. Their free cash flow is starting to expand and it's becoming a very large amount. This free cash flow becomes very hard to reinvest, as Halma primarily grows inorganically by making acquisitions and disposals. A recent acquisition in the US was a software firm to help midwives get notifications on when the baby is about to be due, and I'm not entirely sure if that's the case, but this adds synergy to their overall product line. My issue with this is that they paid through the roof for a technology company in the US, which already trading at a massive premium. I don't think this was a wise use of cash, and I can see now at their £8 to £9 billion valuation that they are really struggling to, or at least starting to slow down the momentum by investing in companies that may not generate as much of returns. And their premium valuation really makes me feel that perhaps it's unlikely that they are going to completely outperform in the future. I do think this is a great company for those interested in dividends, and as my investment strategy has moved away from dividend investing, I'd rather the company reinvested their profits back into the business and made more acquisitions. I could see how in Halma's situation it might be more rewarding for shareholders to continually increase that dividend, which could mean that over the longer term Halma could turn into an absolute dividend beast. But as I said, I'm looking for growth stocks in my portfolio, and Halma, whilst it does have growth potential, I don't feel it's enough for my own risk tolerance, and that's why I've moved into smaller companies with a valuation of around $1 billion or less, with the exception of Boohoo and Games Workshop. At the moment, my position with Halma is an optimistic cash position. That assumes that hopefully they don't drop as much as they did a few months ago, where they fell by around 15% for a low volatility stock, and it pretty much followed the market. What I will do is I'm very likely to sell up, get rid of this position. Halma is going to be gone. I would like to reinvest this into a new company, but if not, I will very likely take advantage of either the dip in Boohoo, Team 17, or Argo Blockchain, which is what I had actually bought this week. Argo Blockchain, with the proceeds of selling 25% of my Halma position and also my weekly deposit of £125. Argo Blockchain has continued to dip, and I'm starting to reach an area where I do not wish to have much more exposure. My total holding size is 2,950 shares of ARB, and 3,000 is going to be my upper limit. At this point, I'm going to have to put the foot down. I don't want to go over this because whilst I believe Argo Blockchain is the best way that I'm aware of getting exposure to Bitcoin and perhaps the FOMO that is involved with it, I don't believe in Bitcoin over the longer term. Everyone has their beliefs, but perhaps I'm being ignorant, and in which point diversification is protection against ignorance. However, this isn't diversification if it becomes my largest holding, and instead that's quite a severe exposure. So I'm very likely to take profits after the speculated NASDAQ listing, which it could 2 to 3 to maybe even 4 times the overall value. I will take profits, trim back that position massively, leave a small exposure to Bitcoin for the longer term, just in case I am being ignorant, and reinvest that into my other long-term holdings in which I have higher conviction. IRB is a very high quality company, but I do need to be careful with cryptocurrencies, as my understanding of them is much more limited than someone that is actively involved in the industry. Games Workshop and Ashtead Group climbed by around 1% each respectively. AHT in the last year really hasn't given up much gains, increasing by over 110%. Although this could be another warning sign, I'm going to stay invested in this stock. They've done very well for me. My total position is up around 88%. And since it's not really that big of a position overall relative to the entire portfolio, and it is less than 10%, I'm just going to stay invested and let my winners run. As for Games Workshop, this is a stock that I would like to buy more shares in, and in fact, this position is the second largest in my portfolio, but with Boohoo dropping and Games Workshop rising, it's becoming very close to overtaking that position with Boohoo. Just at the moment, they're trading around £108 per share. That's a little bit out of my trading range, so if it lowers back down to the £100 mark, that's where I would be looking to buy more. I think at the moment, markets are certainly having a pullback. It seems like in the UK, people are starting to lose interest, and that makes sense to me, as it seems like everyone is interested in buying US stocks. After all, a lot of the popular names said across social media, they're down around 40 to 50% respectively. And so it makes sense as people might be transferring their investments and buying them. Overall, my views are down on the channel, but that's no concern to me. I'm going to keep uploading non-stop and keep an eye on the markets, and hopefully over the longer term the portfolio will continue to develop well, and same with the channel. If you're interested in my Simply Wall Street review and how I find good quality stocks in under a few minutes, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic afternoon.